This week is one of the most important weeks of the entire financial year. JPMorgan Chase, Bank of America, Goldman Sachs, Wells Fargo, Citigroup, Morgan Stanley, and BlackRock are all reporting earnings within days of each other. Big bank earnings season is not just about whether banks made money. It is the single best snapshot of the entire economy available to investors. Why bank earnings matter more than any other sector? Banks touch every part of the economy simultaneously. Consumer loans tell us about household financial health. Business lending tells us about corporate confidence. Investment banking fees tell us about deal activity and market sentiment. Credit card delinquencies tell us about financial stress among regular people. Trading revenues tell us about market volatility. No other sector gives you this breadth of economic information in a single report. What to watch in this week's reports. Consumer credit quality. Are people missing payments at higher rates than last year? This is the most direct indicator of household financial stress. Loan growth. Are businesses borrowing to invest and expand or pulling back? Net interest margins. How much profit banks make from the difference between what they charge borrowers and what they pay borrowers. This is directly affected by the Fed's rate decisions. Investment banking activity. Are mergers, acquisitions, and IPOs picking up or slowing down? The broader economic signal. Banks are often called the canary in the coal mine for economic conditions. When banks start reporting rising loan losses and tightening lending standards, economic trouble typically follows within 6 to 12 months. When banks report strong earnings, healthy credit quality, and growing loan books, the economy is usually in better shape than the headlines suggest. What this means for your investment strategy? Strong bank earnings would suggest the U.S. economic slowdown seen in the weak jobs report is not yet feeding through to actual financial distress. Weak bank earnings with rising delinquencies would suggest the consumer is under more stress than headline numbers indicate. Either way, the answer tells you something important about the economic environment your investments are operating in. You do not need to own bank stocks to care about bank earnings. If you own any broad index fund, banks are in it. More importantly, what banks report this week shapes the Federal Reserve's thinking, affects interest rate expectations, and influences every asset class from bonds to property to technology stocks.